to the South Silver Group presentation of the Scenic Zone Opportunity Zone Fund. My name is Rebecca Personius. I am Jay Personius's daughter-in-law. And we're going to talk through today a little bit about the fund, what it is, what opportunity zones are, and then answer a few questions that you may be wondering about the fund and how it's set up to benefit you from a tax perspective. So with that, I'll pass things over to Jay and we'll get started talking through the fund.
Welcome, everybody. It's really good to see you on tonight. And we also are recording this for the benefit of those that couldn't make it tonight. So we're glad to have you here. Glad that you're interested. I know many of you we met out at the Money Show in Las Vegas a few weeks ago. It was a great turnout, and we're happy to be able to answer any of your questions that you have. So without any further ado, I'd like to go ahead and just kind of walk through a PowerPoint at this point that explains what an opportunity zone fund is. And let me just get my screen share going here. We'll go into slide share mode. All right, so let's talk a little bit about the benefits of an opportunity zone fund. You may or may not realize that these are around, but if you've recently experienced a capital gains event, then this is probably something you are interested in. Unlike a 1031 exchange, if you're looking for a way to minimize your tax gains in your investment portfolio, opportunity zone funds are a great way to do that. And so we are going to talk here a little bit about how they're different than a 1031 exchange, which you might be more familiar with. In a 1031 exchange, you're basically kicking the tax liability down the road. In qualified opportunity zones and qualified opportunity zone funds, they operate a little bit differently. You have to experience the capital gains event, but once you're in the qualified opportunity zone fund, then you will not incur any further taxes at all on the growth of your funds. So it's kind of worth paying the taxes up front, but the nice thing is I can defer those, and I'll talk to you about those in just a moment. So an opportunity zone fund basically operates like an ETF would be in the stock market, except that you're working more directly with real estate. There's a fund manager that invests your funds along with your fellow fund investors into qualified opportunity zone properties and businesses, or property that's owned by those businesses. There's over 8,700 of these locations already in existence, as you can see by the pink shading on the images here to the right. The nice thing is that you experience 100% step up in basis after 10 years of being in the fund. And it's important to understand that you're investing in a fund, not a specific property. The fund manager is actually buying and selling different properties within that fund that may or may not last 10 years. Maybe they reach their peak and they get sold. Those proceeds go back into the fund and are prorated according to your membership shares that you have bought of that fund. Just like in an ETF, any gains by a stock that's sold by the fund manager now gets distributed accordingly to all those that have invested in that fund. But with an opportunity zone fund, you actually realize 100% step up in basis if you leave your funds in there, your capital in the fund, for at least 10 years. And I'll show you a graph of that here in just a moment. And no more taxes are due. So there are some rules that apply to make sure all these things qualify. No real surprises there. IRS has its rules. There are some simple rules for the property or the business that's being purchased. There's also some rules for the fund manager. And there's also an extra form that you have to file with your tax returns to enjoy the deferment of your capital gains that are due today. There's also something that you need to file every year that simply says you're going to keep these funds in an opportunity zone fund and that you are going to continue to defer and have the right to any step up in basis if you hold it there the full 10 years. So it's not much extra work on your part. Most of the work is on the work of the manager to make sure that all the funds are deployed in the proper businesses and for the property or the business that's being developed within an opportunity zone, which is geographical, to continue to comply. So let's do a simple dollar figure comparison between a 1031 exchange and a QOF, as we call it, Qualified Opportunity Zone Fund. Assuming you have $100,000 capital gain that you've realized, that could be something that you sold the end of last year, in which case you have 6 months, 180 days to get that into an opportunity zone fund. Now, if that realized gain was in an LLC that doesn't file the K1 until December 31st, you have until the end of June now to get those funds in. Your 180 days starts when the K1 becomes closed, or that doesn't mean you've received it, but it means that it's the end of the calendar year for that K1 statement. So I'm going to use some simple numbers here. Suppose you have a 20% capital gains tax rate. It could be different from that based on short-term or long-term, either 15 or 24%, whatever the going rate is at the time. But let's just use 20% as an example. If you have 100,000 in capital gains down here, and you want to invest that in an opportunity or into an investment, let's just start with a 1031. If you let that grow at 17.4% IRR or 5x multiple in 10 years, you have grown your investment up to 500,000. Now, if you have that 20,000 that's due today, there is a way to defer that. And I'll talk about that in a moment. But what's happened here is when you've grown your investment to 500,000, you now owe 100,000. 5x taxes are due. Now, with the Qualified Opportunity Zone Fund, you get 100% step up in basis from your original. So you will have to pay this tax here, but we can defer it for a few years. And then everything else that grows tax-free. The other thing that's different, if you were to take a regular investment, let's say you didn't do a 1031 exchange, then you really would only be able to invest 80,000 and not 100,000 because you have to pay those taxes this year, right? So there's some benefits here to actually being able to invest your full 100,000. You're getting better return in your money. You're allowing all of your money to grow for at least these 4 years before you have to pay this tax bill. Now, if you can pay this out of your wallet 4 years from now, then fine, you don't have to take anything out of the fund, which would be to your advantage because now you continue to let that 100,000 continue to grow at its full possible rate. So here, with no additional tax due at the end, you end up coming out ahead if you can have your money invested for the 10 years. So the nice thing here is that if you continue to hold your funds in the Qualified Opportunity Zone Fund and do not take them out after 10 years, you continue to receive that step up in basis even further. So again, it's a good long-term tax strategy. As a fund manager, I can also return up to 100% of your capital during this 10 years with no tax penalty. And you can use this to pay your taxes, or just like an ETF where you can auto reinvest what you've put in, all the dividends that might be coming to you. You can also choose not to take anything out of this if you can pay this out of your wallet at the time, and that will continue to make your growth and increases even better. So we do have a website for this at sceniczone.com, and this information will be available for anybody on request afterwards. So let me stop sharing here for a moment and take any further questions.
Yeah, so just to start things off, and as a point of clarification, I know this can be confusing in some contexts. The additional taxes that you don't have to pay are on the growth of your initial investment, not on your initial investment. So just to clarify, you do still owe your capital gains taxes, but like you mentioned, that can be deferred for several years. Correct?
Yes, it's just one of those things, you bite the bullet now when the bullet's smaller. So
yeah, that's a good way to put it. And then with the Opportunity Zone Fund benefits, to get the benefits of that from a tax perspective, they're assuming that the money is in that fund for 10 years. Is that correct? The 10-year hold applies to your original investment amount, correct?
That's correct. And if you come across another capital gains event in 5 months from now, that 10-year clock starts then for that next amount if you put it in the Opportunity Zone Fund.
Is there any options that an investor has once they've put in their initial amount and it's in the Qualified Opportunity Zone Fund for a 10-year period? Can they do anything creative with their return of capital or the original investment amount? What are the options once that money is in the fund?
Well, first of all, the money you put in the fund is now controlled by a fund manager, and that's important to understand. You don't really have a say as to what it is invested into any more than you do in an ETF when the fund manager decides to buy more of Intel than he does Apple or something like that. So you definitely don't have control there. But what you do have is somebody that's an expert in that field that's trying to make the best return according to the investment thesis of the fund. Now, if there is any return of capital, which you are allowed to have up to 100% of what you put in, again, that will deplete your shares in the fund just as they would in an ETF, possibly if you took anything out. You can do whatever you please with that. There's not going to be any more taxes due on that because it's really just a return of capital. I hope that answered the question.
Yeah, definitely. And then with this fund, I know you mentioned the investors get the K-1s every year. Are there any other details from a tax perspective that would be important for investors to know compared to a traditional syndication or other investment opportunity?
Certainly, there's going to be a K-1. There's going to be some regular evaluation of the fund. That has up to the fund manager's CPAs to produce all of that for the investor. And then there is a form that the investor has to keep filing once a year that says, yes, I have money in an Opportunity Zone Fund and I intend to keep it there, basically. And so it's just reminding the IRS of what they already know, but they want to make sure you're not slipping away with something. They want to know how it's growing. They want to know how much they're not getting in taxes. They want to record all this for statistical purpose to say, aren't Opportunity Zone funds great? All that's going to feed back to our Congress and the Treasury and everything else so that they can kind of keep tabs on the program.
Always leave a paper trail.
Yeah.
Speaking of rules, you mentioned rules applying to the types of businesses and properties that can be purchased with a Qualified Opportunity Zone Fund. Can you speak a little bit more to those and what implications those have on the fund itself?
That's a great question. With a 1031 exchange, the investor is forced to invest from a like to like type property. And a lot of the 1031 benefits have been eroding over the many years. They've served whatever purpose that the government and the Treasury decided to do, and that is to get people to invest in things and grow economies. But it hasn't been as great a deal as these Opportunity Zone funds are going to be. The nice thing about an Opportunity Zone Fund is that it can invest in all sorts of business types. We can talk Burger Kings, wineries, construction companies, real estate, multifamily, new development, a lot of different things. You're not limited in the like-to-like restriction of a 1031 exchange. And this gives you a far greater diversification opportunity, and it allows you to invest in things that could have a much higher return than your typical multifamily or something that you're investing in with your current funds. So it's certainly something to give consideration to.
And then on top of that, compared to a syndication, people who invest in a fund, their investments are diversified across multiple assets, not just a single deal. So you're really not limited in the performance of one specific asset, but you have that opportunity for the fund manager to effectively distribute that risk across multiple properties or businesses. So
That's right. And the nice
that's
thing
awesome.
too about an Opportunity Zone Fund is that the fund manager can invest in any of these 8,700 locations. So we're talking different states. We're talking Puerto Rico. We're talking the U.S. territories. We're talking, mountainous areas, river areas, urban, rural, anything where we can find a good deal. And so as the fund manager, I'm going to be looking for great assets. I'm looking for great operators. I'm looking for things that really fit the bill to provide the best opportunity for people. In my case, my Opportunity Zone Fund is centered around scenic areas. I'm looking for those rural properties that are undeveloped, that can benefit new economies, but at the same time can be beautiful places to visit. And so recreational real estate is one of those places. And there is a lot of opportunity out there that is where people are not looking. And that's where we're looking to have some pretty good potential deals. We're talking about mountain resorts that have been owned by mom and pops that need a severe upgrade. We're talking about new development of RV parks and cabin venues and these kinds of things. And we have an example already of what we're going to be investing in, and we'll show you that here during this webinar as well.
Awesome. Yeah, that's great. And then just from a comparison standpoint for the number of peoples among us, what are the breakdown of fees or returns to the investors that we might be able to expect at this stage with the fund? What are we looking at as far as targets or expectations?
Yeah, so I've designed my fund, it's called SSG OZ Fund, Doing Business as Scenic Zone Opportunity Zone Fund. So if you see the PPM, you're going to see this long name, but what I've designed in there is very low fee structure on purpose. I want to really, first of all, get this fund off and going in a way that it's kind of new to a lot of people. And so we're giving an 80% position to all the investors, and we're giving an 8% preferred return. So we want to bring comfort and confidence to the investor that we're going to be able to give you the fair shake of everything that's going on, because as an investor, you're going to get paid first because of the preferred return. There is a very small management fee to continue the cost of operating the fund, but it's only 2%, and it has it's not a big gouge out of what's going on here. So people are going to be treated right in this fund.
Yeah, prioritizing investors and benefiting the communities. I think that's in our mission statement. So that's awesome. Speaking of, what would you say is the best type of investor for this fund? Who would most benefit from this type of fund investment opportunity?
Excellent question. First of all, you need to be qualified to invest in the fund, and that means that you have actual capital gains that you owe the US government. Okay, you can be an individual, you can be an entity. There's a lot of other variations of that. You actually have to have a taxable event. This is not a deferment program. I can defer when your taxes are due for 4 years, but I'm not going to defer your taxes for this event any longer than that unless the government extends them. Okay, and that is a possibility. They're working on some changes due later this year. But an investor here would be somebody that does not need their capital right away. This is a 10-year hold. That should be expected. Somebody that's building a legacy in their family trust or in their family business, where you are wanting to put your excess out there, your profits, if you will, the gains that you've had from being a smart investor, and you don't need those funds right away. There is penalties, of course, if you get your money out of this fund sooner than that 10 years. There are ways to do that if the fund manager can afford to do that without jeopardizing the investment. So your second seat to the fund manager, let's be honest, okay? There are legal situations that people might need to get out of them, and that is also possible. You'll have a hit on that. I can't say what that is at this point. I'm not a CPA, right? There's one of my disclaimers. I'm not legal advice either. All right. But that's called an inclusion event, and that can be a divorce or a change in the state of some sort, or a lawsuit or death or something like that. There are some cases where the beneficiary position in the fund can be transferred without penalty, but those are limited, and so don't be expecting that. Check them into it before you invest. That would be my advice to that.
Yeah, and I think it's a good perspective to keep in mind. This is not a liquid asset like the stock market or something that you can get into and out of quickly, but there are some long-term benefits that you can't get elsewhere with this type of fund. So that's pretty
those that
cool
are
to learn
planning
about as
ahead.
well.
This is
Yeah.
those that are planning ahead.
Speaking of, can you talk a little bit to the deal that you're looking at for the Scenic Zone Fund and what it has to offer for investors?
Yeah, certainly. South Silver Group is also a partner in the deal I'm going to share with you. So full disclosure there. And I've deliberately done this because I want to make sure that it's done right. It's in the opportunity zone. Long-term friends with the people I'm partnering with. And so what we're working on here, and I'll share my screen again. I will bring up the pitch deck, if you will. There we go. So this new entity is called Willows at Watson, and it includes on part of this land is the Mountain View RV Park, Oklahoma, which is already open. Now, this is 147 acres of beautiful property in southeast Oklahoma in McCurtain County. It's a tribal nation area, and it is economically identified as being qualified for an opportunity zone. So it sits 100% inside an opportunity zone. It has its own lake. It has plenty of land for development, and that's what we're planning to do on here. And I'll not read all of this, but it's a booming town, a booming area here in Ho Chi Town, Broken Bow, and Beavers Bend State Park, where there's a lot of activity going on in that space. And what we're looking for here is to combine a beautiful view with RV spots, along with lakes and trails with more amenities. I'll go into those in a moment. And it's to develop this, the vision is to develop this acreage with cabins, food, beverage services, wedding venues, recreational activities. And no, it's not going to become a crowded urban area. It's designed to be spread out, very spacious, and very beautiful. And so we're going to be capitalizing on the growth and interest in Southeast Oklahoma. It's now being called the next Branson, Missouri, if you're familiar with that. I think that's a little bit out there at this point, but there definitely is a lot of movement going in that space. A lot of people from North Texas go up there for vacationing. Weyerhaeuser is the lumber company that owns most of the land up there or has rights to it, and they're selling that off in 100-acre lots, and people are buying them up, just scavenging these to put into turn into 1-acre cabin lots, and it just can't build them fast enough because of what's going on. There's an increasing amount of RV travel going on up in the space. This happened also because of COVID. People wanting to get out of the house, and now many people are just enjoying more of a mobile lifestyle to begin with. So we're still seeing the residual effects of that movement. There's also lack of alternatives up in that space. The Ho Chi Town Broken Bow area has, until recently, has not been orderly designed, or designed in an orderly way, I should say. And so it's wherever people grab things and get things done. They've not needed permits, even though they've built nice properties and things. It just has been unorganized. And so just this year, Ho Chi Town finally incorporated. And so they're going to begin to be putting down some rules and regulations in order to make it look more consistent or widen the streets or whatever they need to do. Now, this Willows at Watson is located northeast of Broken Bow, about 45 minutes to an hour. And the plan here is to continue to upgrade the RV park, put on cabins, hobbit shires, like what you see here. There's very few places in America that have those. These are great honeymoon suites, getaways, romantic little venues, and they are going for top dollar. And we have a nice hilly landscape in this property that's just perfectly suited to that kind of a situation. We're also planning to put in a trade days. We'll have over 64 spots for vendors. This is a sample from a different venue, but you have little places where each of the vendors can display their wares, put up their carvings, sell their little trinkets or whatever it is they're doing. And we plan to turn that into very, very profitable trade days up in that area. This whole park sits on Highway 4 between Arkansas and the road that goes north through Broken Bow and Idabel Ochetown area. And there is a lot of traffic there. We expect that to be more northeast of this park area. Walmart has invested millions of dollars into some bike trails that will be put up in Arkansas to 1,500 miles of bike trails. And so there's really a big development northeast of this park. And so this will be nicely situated between Ochetown and there as well. And we hope to catch a lot of the traffic that's going around there. There's also 100 and some odd acre housing development on 1 acre lots just to the east of this property. And so this place is already getting noticed. And we plan to be riding that tidal, that wave as everything gets developed. We also are going to be putting seasonal attractions around the lake. We're going to have a nice path, and we're going to put up seasonal Christmas lights and maybe even some Halloween attractions, maybe some 4th of July things where we charge parking fees. The idea here is that we want people to be able to come to this park and have a complete vacation, not just pass through for one night and move on to something that's more interesting. We want to put the interesting right here in the park. We also plan 3 major wedding venues of different sizes. We're just throwing stock images here. At the moment, our pine trees aren't quite that thick and big, but we will be nestled in the trees and have the beautiful views. And we also will have a reception hall, indoor reception hall, can also be used as a wedding venue, and we'll be able to cater services out of there as well. So the big plans, and it's going to be about a little over $14 million development. And we hope to get that started here this fall.
I think that's awesome. I think that's one of the primary benefits of recreational real estate is just if your imagination can come up with the idea, you can probably cash flow it. And I think one of my favorite features of this particular venue is just the competitive edge they have with Wi-Fi, if nothing else.
Oh, thank you for
RV parks are not known for their internet speed. So
right, the highway that goes right in front
but
the highway that goes right in front of the park is the fiber line. And the current
to be very
owners,
convenient for this park.
yes, well, they realized that, and I said, you need to turn that into an ISP, and they did. So they have not only just the ability to give Wi-Fi to the park, they can also sell it to their neighbors. So it's quite a deal. So there's also just a lot of things going on in the RV space. There's some market analysis that's available in this pitch deck. The RV parks are limited in this area. Most of them you can only pull in one way. You can't turn around, and you have to leave on the same direction on the road that you came in on. There is just no way to really get in and out of some of them because they're crowded between the highway and the river that was not intended to be, set up for an RV park, but that's typical. There are a couple others with a little bit more spacious, but there are 0 amenities. You basically are camping in your RV, and some people like that. You can do that at this park as well, but we plan to make it a full destination type resort type event. So the numbers I'm going to share with you, just keep in mind, I'm not a CPA, I'm not a legal advisor. I'm going to give you some information of what our expectations are here from the pro forma and what we hope the RV park itself will do, Willows will do. But you'll have to do your own due diligence as an investor. So we're looking to raise $14.2 million. It's a 506C, meaning it's for accredited investors only. For those of you that aren't sure of what you are, the irs.gov has a page on this, and there's some 50-some categories of what qualifies to be an accredited investor or not. The nutshell of it is, the condensed version is, you have a net worth of $1 million or more, not including your primary residence, or you have an annual income of at least 200,000 a year, and you expect to have a second year in a row of that. If you're using a combined income, then it needs to be 300,000 a year to be an accredited investor. Basically, the SEC is saying we're trying to set stricter rules for those that may not know what they're getting into. And if you have $1 million worth of net worth, you probably know how to manage your money well enough, and you know what you're getting into. But there are still rules that apply for 506C as well. It's just not quite as stringent as a 506B. A 506B allows non-accredited investors, if they have some exposure to what they're getting into. And we're not pursuing investors in that category. This is such a large raise that we're really looking for people that can afford to put some capital into this.
Speaking of accreditation status, that same criteria would apply if you're investing in the Scenic Zone Fund as well, right? Just to clarify, this is a separate deal. You could invest in Willows at Watson without being involved in the fund, or you could do both, depending on how things flow out.
That's right. Thank you for mentioning that. You can invest directly in Willows. If you invest with your capital gains, then I can't do anything. If you put your capital gains directly into Willows, I can't do anything about the deferment. And you don't have to file all the extra paperwork either, but you will pay your taxes this year. On the other hand, if you have both capital gains and other basis that you're getting out of a deal, you can put the basis in Willows and you can put the capital gains in the Opportunity Zone Fund. Again, keep in mind that they really are two separate investments. If you put your money in the Opportunity Zone Fund, I, as the fund manager, am going to be investing in multiple things, not just Willows. So keep that in mind. And the hold periods are different.
Good clarification. Yeah.
So Willows at Watson expects to be a 5 to 7 year hold. It will cash flow in year 3. This is because it's a development project. One of the criteria for a business or property in an opportunity zone to qualify for the tax benefits when invested in by a fund is that it is either original use, meaning raw land, or you're making a significant improvement, meaning 100% additional capital is being put into it. And both of those, I should say either or those criteria need to be done within 30 months. So we plan to purchase this property. We just had it appraised for $3.5 million, 3.7 actually. And so we're going to put another 3.7 minimum into it within 30 months. We actually plan to do the full 14 million and make sure that we qualify there. Because it's development, it'll take a few years to get the cash flows, but once that is done, the cash flows are very strong. So we plan to begin construction immediately. There is a phased approach to this, partly because of the seasonal aspects, partly because of the duration it will take to raise all of the capital. You'll see that here in the pro forma in a moment. We're not using bank financing at the moment because the interest rates are high and there really isn't any cash flow other than the RV park here to speak of that would justify a larger loan. It would be a construction loan at a very high interest rate, and we would rather pay that interest, if you will, to the investor. So once we have additional amenities and venues on the park, on the grounds, then we'll look into financing. But we do not anticipate any capital raise beyond the 14 million. So for that 5 to 7 year hold, we're looking at least 18% internal rate of returns, 2.2x in 5 years, 2.7 in 7 years. And again, I'll show you the pro forma here in a moment. Capital stack in the park itself is a 70-30 split. It's designed that no matter how many investors we have in class A, B, C, or D, and I'll explain that here in a moment. Class E, which is the general partners, will always hold an undiluted 30%. And so we're getting the legal documents written to explain that more clearly. We're looking for a $50,000 minimum investment. And as we mentioned, it's for accredited investors only. The development team is myself, and then Coy and Michael Greathouse, father and son, or I should say son and father. And then Cody Moore, who has been their project advisor and helped them get this project started 2 years ago. I might add that they've put about 1.5 million into the land already. And as I mentioned, it's already been appraised at 3.7 in just 2 years. And so we know that that area is really booming in value. And so we're getting in still at the ground floor, if you will. So again, I mentioned there's 2 investment options. One is to invest directly into Willows at Watson. The other is to invest in the Qualified Opportunity Zone Fund. We can give you this pitch deck anytime you want. We will have an investor portal. There's a way to get to the sign up, be able to request the PPM. That's option one. There's some tips that I've already explained about opportunity zone funds. And then here's option two, which is how do you invest through the fund itself? Again, another QR code that will take you to the proper channels. Contact information is also available. And so this pitch deck is available to anyone upon request.
Awesome. Well, thanks for that example. I think that's a great way for investors to kind of preview what kinds of deals and businesses and properties the Scenic Zone Fund would be purchasing or looking at acquiring, as well as some of the potential benefits that they might realize by being a part. So I think at this stage, just next steps for investors who might be interested specifically in the Scenic Zone Fund, just getting in touch with us. We'll provide our contact information as well. And then we do have a separate webinar we're doing on the Willows deal itself separately from this particular event. So we'll be sure to make that recording available if somebody has a specific interest in that. Any follow-up thoughts or closing remarks you'd like to share for potential investors?
Absolutely. There's a couple things. First of all, visit our website, southsilvergroup.com. That will show all of our deals that we have out there. Another thing is to visit sceniczone.com. That has the specifics about the Opportunity Zone Fund itself. We also have a YouTube channel, South Silver Group. So check that out. We'll put up our videos up there. We have more to come up there as well. So that's three things that you can do. Always reach out to us. The contact information will simply be fundmanager@sceniczone.com, or you can reach either Rebecca and I, Jay at South Silver Group, or Rebecca@southsilvergroup.com. So, and then phone number, if you will, is 817-720-0170. That's 817-720-0170. Call us anytime.
We look forward to working more with each of you and answering any additional questions you may have. And with that, we will close out the webinar.